Welcome back. I now will discuss forecasting of free cash flows. Again, this is a very practical subject and quite often not well understood in the academic literature. Now, what's our objective? So for a DCF model, I need future cash flows. The model itself is completely trivial. It's just some basic linear algebra, which I can easily do in Excel. There is not much to it in terms of modeling. There's not much happening. The main difficulty, however, is to understand how to obtain the forecasts for free cash flows. And there are a few ways to approach this problem, and whatever you do, you have to accept certain limitations. Now, in practice, so when I did valuations in consulting, the focus always was first on understanding revenues. So understanding the flow of money that goes into the business, not directly modeling the cash flows. The reason is revenue is easier to understand and easier to predict because I can use certain sources like industry reports to get an understanding of it, and also I can use global trends, and I'll talk about this in a minute, to understand the need for a certain product. So that is an awful lot easier as a starting point. Now, in terms of markets, we then of course understand as well whether a market is more or less saturated. Yeah, so in a saturated market, you would not assume very high revenue growth rates going forward, like in the case of Kellogg's. It's quite unlikely you would see high growth in this particular case. And also you have to understand natural limits. Yeah, so it is very implausible that a certain industry can grow forever above nominal GDP. Yeah, otherwise the share of the industry will increase up to the industry being the economy. So it's also important to note, for instance, if you analyze certain industries, for instance, healthcare. In healthcare, we have seen for quite some time an increase in terms of healthcare compared to GDP. So the share of healthcare expenditure has gone up for various reasons. One important reason is certainly demographic change. However, it's not very plausible that this will continue forever. It's quite likely it will settle at a certain level. The issue is at what level. The same in education. When you look at, for instance, tuition fees, in particular in the US, you have massive growth, way above inflation, way above nominal GDP, yeah, which also means in terms of the size of the sector, it grew over time. But again, it's unlikely to continue. Yeah? And again, you can then argue what will happen most likely next. And so we have to always assume that there are certain natural limits to revenue growth. And usually what happens in mature markets is that these markets tend to consolidate. So you see more mergers and acquisitions, and the focus shifts more to profitability and less to growing the business. Of course, there are some cases where growth and profitability are much more strongly interrelated, and we have to talk about these cases in a minute. So we summarize here, the focus for forecasting is usually on the revenue side. Once I have a revenue forecast, I can derive a free cash flow from it. And this is done through various ratios. And we will talk about this in more detail. So in my case, to summarize, the benefits are clear. It's much easier to forecast revenues. I can do it fundamentally based on two main drivers. So you can increase your revenue if the market as a whole growth. So this depends on macroeconomic conditions, demographic effects, and so on. Or if you change your market share, and this depends on your competitive advantage. Yeah. Again, there are always limits and issues with all of that. Yeah. The other thing is it works quite well if the industry is quite stable. So if your profitability level is more or less stable, like in the case of Kellogg's, making assumptions about revenue is a good starting point. Now, the disadvantage is in some industries you have a strong link between your size and your profitability. And this in particular is the case for online business. Because in this case, we have what you call positive externalities or network effects. Yeah? If you think, for instance, about social media depends crucially on the number of users. If nobody is using a platform, the value of a platform is zero. The more people that use a platform, the more use it has. Yeah, so growth reinforces profitability here. Yeah, this is why you see in these areas that companies focus much more on growing a platform, reaching scale. And also it depends on whether your idea and your business is scalable. Yeah, in the case of online business, it's much more scalable than running a standard business where you need literally brick and mortar. Yeah, so if, for instance, you think about retail, if you are a traditional retailer where you need stores to serve a certain area, growth is of course strongly linked to your abilities to invest, your abilities to put in more stores, physical stores. So you need of course more invested capital for that. So growth will be to some extent limited. If you do an online retail shop, well, it's far less limited. I can scale it much quicker. Yeah, so there is less of a burden when you grow the business. Yeah, so that is quite important. The other issue is in some industries you have a cyclical nature of the business. Yeah, the most famous one would be, for instance, steel. So steel undergoes ups and downs. Yeah, also commodities. You have commodity cycles. So they tremendously affect profitability because everything is linked to prices in this case, and in particular in commodities, you can't differentiate your product really. Yeah, so oil is oil to a large extent, not quite, but to a large extent. The other thing, of course, is technology. So some industries are easily disrupted by technology, and of course, again, this really matters for forecasting. But for our example, so if you look at Kellogg's operating in consumer goods, you can use this method, quite successfully. In other cases, you might need to modify it. So how does it work? So these here are the mechanics. Yeah. So basically, you start with understanding your revenue forecast, and you can do it in the short term, as we mentioned before, using analyst reports. And then you make a longer term forecast based on assumptions. So basically you put in a more or less plausible growth rate. We will do several, exercises during our April, visit to play around with various assumptions and see what happens. And then we have to link revenues to costs. How do I do it? Well, I do it based on ratios. Yeah, we already looked at cost of goods sold revenue ratio and SG&A revenue ratio. So we use these ratios to construct operating costs. Of course, that assumes that these ratios remain constant, which of course might be the case in a stable business, in a stable industry. But again, of course, these are assumptions and you might need to challenge them. And then, of course, you can derive from that NOPLAT. So that is quite easy. Now, the next thing is when you have to link your revenue to invested capital. How do you do it? You look at so-called capital turnover. Yeah, revenue divided by invested capital. Again, you have to look historically whether this is a stable ratio. If it's not stable, you have to be very careful. However, if it seems to be quite stable, you can use that as a starting point to forecast invested capital. In most cases, you would assume that goodwill and minority interest remain unchanged over time, except you have a good idea why it should be different. For instance, you have a planned acquisition, or something is happening with your ownership structure. Now, the level of debt is simply there in the model, and you will see this once we go into the modeling part, to balance the balance sheet. Yeah, so this is why we use debt. And again, we have to look whether the debt level predicted is sustainable. In most cases, it would predict that debt level will go down over time. Yeah, this is plausible if you have positive cash flows generated. But we have to be careful in companies where we need substantial levels of debt to maintain growth. So this can be quite quickly unsustainable. Then we have to look at interest expenses. Again, it's linked to debt. So once you know the debt level, you know the interest expense, you just use the interest rate. And then, of course, we have to make some adjustments for taxes. Yeah. Then we look into net income. Yeah. So here, net income is, of course, needed to understand how equity is changing, because that can be used as retained earnings or dividend payments. We don't look at distribution here, so we don't consider dividend payments. So anything we earn and which would be an equity cash flow would simply go into retained earnings and would increase our equity position. So these are the main components. So these are the mechanics of it. Yeah, but again, it's very important for you to understand what are the underlying assumptions. So here is just an example of the forecasting periods. As we discussed briefly before, you have a short-term period. So here you tend to have either analyst reports or you talk to management, and you have already clear plans by management what they try to implement. Then you have a midterm period, maybe 10, 15 years, where you make assumptions focused usually on revenue predictions, and then you link it using ratios to costs, and then you build up your model and you derive your free cash flows. Now, the main argument for these assumptions might be driven by what you call global trends like demographic change. This is very, very powerful, honestly speaking. Population aging, again, very, very powerful. And then you might develop certain scenarios. And we talk about this a bit more later. What are plausible scenarios in this case, where you might change a whole set of these assumptions. You have to be careful if you are dealing with cyclical business. Yeah, so here you need, if you do historical analysis, you need longer time periods to get reliable estimates for cost ratios, for instance. Just an example now for Kellogg's. I think it's plausible to assume that you don't have a high growth company in this case. The main value driver in Kellogg's is, of course, profitability, which seems to be quite stable in this particular case. And also because of high profitability and low growth, you don't need much money, which means if you do a debt forecasting, you quickly actually get rid of debt. You don't need it. So in terms of sustainability, it wouldn't be a problem. So a conservative model would assume that you don't grow very much at all. You have more or less a steady maintained level of invested capital. You generate free cash flows because of high levels of profitability. So that's all I wanted to highlight in this section. I see you in the next.